Hello and welcome to the monthly global forecast from the Economist Intelligence Unit. I'm Tony McMahon, and as ever I'm joined by Robin Bew. Robin, what evidence is there that the global economy is actually stabilising?
Well, there's been a number of more positive data releases in a large number of countries around the world. So if you look at anything from kind of mortgage applications to some housing market data, a little bit of retail sales numbers, even some manufacturing data around the world, America, Europe and even in Japan, some of those have ticked up. I think the difficulty though is trying to tease out an underlying recovery from more temporary factors, and there's two temporary things in play that we have to be aware of. One is that the inventory cycle is starting to turn. At the end of last year, a lot of firms just stopped producing because they had far too much stock on hand, and they've now ran down their inventories, so production is starting, which is unambiguously a good thing. But the question is, will that production continue if we don't see demand start to pick up? And at the moment, we don't really see that. The other temporary factor in play is, of course, the fiscal boost. Tremendous amount of liquidity being pumped into economies by governments in most markets. And that, again, is driving real activity. But, of course, we know that governments can't keep this up forever. So the question is what would happen when that particular tap is turned off. So at the moment, there are green shoots. They are real. And things are genuinely improving. The worry is that it could be transitory.
And in your forecast, you're talking about growth with volatility. Can you expand on that scenario?
Well, I guess it takes you a little bit closer to this frightening W-shaped recession that people talk about. I mean, clearly the fiscal stimulus and the monetary stimulus that we see at the moment is very significant, and in some markets it's making an enormous difference. We think it's making something of a difference in America and in Europe, making an enormous difference in China. But we also know that that stimulus is time limited. It will be withdrawn later on this year. And at that point, judging from what we see going on in the private sector, you have to imagine that growth is going to slow again. So we have an uptick in the next few months, followed by a bit of a downtick after that. If the private sector doesn't recover, I think it's right to assume the governments will step up to the plate once again, and then things would improve, and you end up with a story that looks rather like Japan in the 1990s, which is you see these periodic bursts of optimism of governments really put their foot on the accelerator, followed by a wave of pessimism where everyone realises it hasn't really worked properly, and then the governments have to step back up to the plate, and that makes for a very bumpy ride in the real economy, but then also, of course, in financial markets who are responding to all of this.
Standard & Poor's have put the UK on negative watch. What's your view on the UK's finances?
UK public finances look pretty bad. We have an enormous public sector deficit, and that's rolling through, of course, into a dramatic uptick in the debt stock. And then on top of that, of course, you've had the need, which is clearly not unique to the UK, of having to nationalise a large number of financial institutions. And while it's a bit unclear exactly how that's going to knock through into the official finances, it is pretty clear that the government's on the hook for an awful lot of debt that it didn't look like it was going to have 2 years ago. So obviously things are worrying. I think in the UK specifically, though, of course, investors don't regard sterling as a must-hold currency in the way perhaps they regard the US dollar as a must-hold currency. So as a result, it's more difficult for the UK government to get some of the bond issues away that it needs to get away, and that raises the risks. And of course, the credit rating assessments that you're seeing, this kind of threat of a downgrade, reflects in part the fact that, like many economies, UK needs to attract foreign money to fund its deficit, but people don't have to buy sterling, and that clearly poses a risk.
And there's a possibility of a downgrade looming for the United States. Is this the end of the honeymoon period for President Obama?
If you asked Obama, I suspect he feels he hasn't had much of a honeymoon. It's been pretty brutal, but certainly in terms of the economy. And then, of course, it's more widely. There's a whole lot going on geopolitically as well around the world, which is not related to the economy and is clearly proving to be quite difficult to manage. It's going to be really tough. And I think the thing that we've been saying for a long time, but I think commentators have started to ignore, was that actually the economy is in a very bad state, and it's going to require a lot of government work to get us out of this. And the implications of that government work, which is this massive run-up in debt and deficits, and actually what's going on in monetary policy as well, will have significant and long-lasting consequences. And perhaps the thing that people didn't fully take into account is that big deterioration in the policy environment was going to come on top of the deterioration we were already going to get because of the fiscal position around healthcare and social security because of the ageing population. So he has all that to deal with. And of course, the political system in America means that the administration is not the only game in town. They have to bring Congress with them. That's very difficult. So it's really very tough for him.
You still see the dollar on a downward trajectory in spite of possible periods of recovery in the months ahead?
Yeah, and I think there's two slightly separate things going on with the dollar in terms of that weakness. Right now we have seen some softening, and I think that that is actually around people becoming a bit more optimistic about the world economy. When people are frightened, they run into the dollar because they view it as a safe haven. When people feel a bit more upbeat, they move out of the dollar into risk assets, so commodities or emerging market equities or whatever it is, and that process involves selling dollars, and that pushes the dollar down a bit. The volatility will come if people start to worry that actually these green shoots are going to peter out. They might flow back into the dollar, and the dollar actually strengthen a bit. So in the short term, dollar weakness actually implies a bit of optimism about the global economy. When you look out further, though, I think the dollar will be weak for different reasons. The dollar will be weak because people are very worried about the fiscal position and the monetary position, and that perhaps creates a danger of inflation being a bit higher than people are assuming. So right now, soft dollar is actually a sign of global economic strength. But when we look out 4 or 5 years, I suspect we'll get a soft dollar, but that will be a sign of people's lack of confidence in the US economy, so a completely different story.
Thank you, Robin.
Thanks very much.
Well, join us again in a month's time to see if those green shoots of recovery have grown a little. Until then, thank you and goodbye.